Something just changed in the U.S. crypto legislation that matters far more than it looks. If Congress fails to pass the Clarity Act before the Senate recess, lawmakers may not get another realistic opportunity until 2030, potentially extending years of regulatory uncertainty for digital assets, banks, and institutional investors. In the next few minutes, we'll break down why this deadline matters, the 3 political hurdles that could determine the bill's fate, and what the White House's role really is, and what all of this could mean for the future of digital assets, including XRP and broader institutional adoption. The countdown has already begun. According to Senator Cynthia Lummis, missing this week's deadline doesn't simply delay another crypto bill. No, it could postpone comprehensive digital asset legislation for years. That's a remarkable claim, but when you look beneath the headlines, you begin to understand why so many lawmakers, financial institutions, and investors are paying such close attention. Most coverage suggests this is simply a political fight over ethics. It isn't. Behind closed doors, 3 separate negotiations must all reach agreement before the Senate can even move to a floor vote. At the same time, bipartisan support remains fragile. Several Republican senators still have concerns over stablecoin provisions, and one written response from the White House could determine whether the entire process moves forward or stalls. Now, this is what most people miss. This debate isn't just about cryptocurrency. It's about whether the United States creates the regulatory foundation that allows banks, institutions, and financial markets to participate in the next phase of digital asset infrastructure, or whether that opportunity continues shifting elsewhere. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Also, thank you to everyone who takes the time to like and share our video. It really helps our channel out a lot. But here's where things become much more interesting. Most media coverage has reduced this debate to a single issue: ethics. Every headline seems to suggest that legislation is stuck because lawmakers are arguing over conflicts of interest involving digital assets. While ethics is certainly important, that's only one piece of a much larger puzzle. In reality, Senate negotiators have been attempting to close 3 completely different legislative gates simultaneously. Think of these as 3 locks on one door. Opening only one doesn't accomplish anything. Opening 2 still isn't enough. Every single lock has to open before the legislation can advance. The first gates involve ethic reforms. The second involves revisions connected to the Bank Secrecy Act and related compliance provisions. The third focuses on agricultural language connected to regulatory, jurisdiction, and oversight. Each issue has its own supporters, its own critics, its own negotiations, its own political calculations, and every compromise reached on one issue has the potential to upset negotiations on another. That's why progress has appeared slow from the outside. Lawmakers aren't solving one problem. They're solving 3 interconnected problems simultaneously. Miss just one, the entire bill stalls. This is one reason Senator Cynthia Lummis has repeatedly emphasized the importance of this week's deadline. Legislative calendars matter. Congress doesn't simply return and pick up exactly where it left off. No. Political priorities change. Election cycles begin dominating attention. Committee schedules shift. Leadership changes. Negotiation coalitions evolve. Momentum disappears. Anyone who follows Washington understands that timing can be just as important as policy. History offers an important reminder of this reality. During the Panic of 1907, the United States experienced one of its worst financial crises before the creation of the Federal Reserve. Confidence evaporated. Banks faced liquidity shortages, and markets froze. The crisis ultimately convinced policymakers that America needed a stronger financial framework to prevent similar disruptions in the future. That experience didn't just reshape banking. It led to the creation of entirely new financial institution designed to provide stability. Today's debate over digital assets isn't identical, but it reflects the same broader principle. Periods of financial transformation often force governments to rethink existing rules. The question isn't whether change eventually happens. The question is who writes the rules first, because whoever establishes the framework often gains a significant competitive advantage. Now consider the political mathematics. Passing legislation of this scale isn't simply about convincing one political party. Senate requires 60 votes. That means bipartisan cooperation isn't optional. It's essential. Previous crypto legislation demonstrated that bipartisan support is possible. Several Democrats crossed party lines to support earlier measures, but the Clarity Act is considerably larger, more comprehensive, more politically sensitive, and therefore much more difficult to assemble. Republican leadership must maintain support within its own caucus, while simultaneously attracting enough Democratic votes to reach the required threshold. That's easier said than done, because even within the Republican Party, there are still lawmakers expressing reservations. 3 Republican senators remain particularly concerned about provisions involving stablecoin yields. Those concerns have complicated negotiations considerably. If Republican support weakens, additional Democratic votes become necessary. If Democratic support weakens, Republicans must remain united. Every vote matters. Every conversation matters. Every amendment matters. This isn't merely legislative strategies. It's political arithmetic. But here's what many people completely overlook. Some of the strongest opposition isn't necessarily coming from politicians. It's coming from parts of the traditional banking industry. At first glance, that sounds surprising. Wouldn't banks benefit from clear regulation? Yes, eventually, but not necessarily from every provision contained within the legislation. One of the biggest concerns revolves around stablecoin yields. Banks worry that if consumers can easily earn attractive returns through tokenized dollar products, traditional bank deposits could begin migrating elsewhere. Deposits remain one of the banking system's most valuable resources. They fund lending, support balance sheets, generate profitability. Anything that threatens deposit stability naturally attracts resistance. So banks have publicly opposed certain portions of the legislation. Yet this creates an extraordinary contradiction, because without comprehensive legislation, banks themselves remain constrained. Without regulatory certainty, compliance departments become extremely conservative. Capital allocation slows, innovation slows, expansion slows. Ironically, the very institutions resisting certain provisions may ultimately need their legislation far more than they publicly acknowledge. It's not a simple story of banks versus crypto. It's a negotiation over competitive positioning inside a rapidly changing financial system. Now, this is what most people miss. Banks aren't trying to stop digital assets forever. They're trying to influence how digital assets integrate into the existing financial system. That's a fundamentally different objective. Every major technological transition creates similar negotiations. Incumbent institutions rarely oppose innovation itself. They usually seek rules that preserve competitive balance while allowing gradual adoption. We saw similar dynamics throughout financial history. When electronic trading expanded across global markets, established exchanges didn't reject technology outright. They fought over market structure. When online banking emerged, traditional banks eventually embraced digital assets, but only after regulatory frameworks matured. Digital assets appear to be following a comparable path. The debate increasingly revolves around market design rather than technology viability. Meanwhile, another obstacle continues influencing negotiations in ways that legislative text alone cannot solve: the shadow of FTX. Even years after its collapse, the political consequences remain significant. For many lawmakers, particularly among Democrats, FTX fundamentally altered perceptions of the crypto industry. The collapse wasn't simply viewed as one company's failure. It became symbolic. Public trust suffered. Political trust suffered. Media narratives hardened. Even though the Clarity Act contains consumer protections designed specifically to reduce future risks, emotional reactions continue influencing legislative discussions. Some observers describe this as political PTSD. Whether or not that description is fair, the underlying point remains important. Politics isn't driven solely by facts. It's also shaped by perception. Once confidence is damaged, rebuilding it takes far longer than drafting legislation. That's one reason negotiations have required extraordinary patience. Supporters aren't simply debating policy. They're attempting to rebuild political confidence after one of the industry's most damaging episodes. History provides another fascinating comparison. After the South Sea bubble of 1720, confidence in financial speculation collapsed across Britain. Lawmakers responded with stricter rules, investors became deeply skeptical, and innovation slowed for years. Yet financial markets didn't disappear. Instead, they gradually evolved under new regulatory structures that restored confidence over time. The lessons were remarkably consistent. Major financial scandals rarely end innovation. They reshape the rules governing innovation. And that may ultimately be what's happening today. The Clarity Act isn't simply attempting to encourage growth. It's attempting to establish guardrails that allow growth to occur with greater institutional confidence. That distinction matters enormously because institutional investors don't just evaluate opportunity. They evaluate legal certainty, and legal certainty is exactly what the legislation aims to provide. But perhaps the most closely watched negotiations involve ethics reforms. This is where Senate leaders from both parties are attempting something unusually ambitious: Rather than simply relying on existing disclosure requirements, negotiators developed proposals placing significantly tighter restrictions on digital asset involvement by senior government officials and their immediate families while in office. Supporters argue those measures could reduce conflicts of interest and strengthen public confidence. Critics continue debating how enforcement should work and whether additional authority should be granted beyond existing federal mechanisms. That debate has now become one of the final pieces standing between negotiations and a Senate floor vote. And behind the scenes, attention has increasingly shifted towards one critical question. How will the White House respond? Because without a clear written proposal supporting the latest bipartisan compromise, uncertainty remains. And in Washington, uncertainty can delay everything. The story doesn't end there. The White House response may become the single signal that determines whether this legislation moves forward or whether Americans' digital asset industry enters another 4 years of waiting. That is why so many people in Washington aren't simply watching senators anymore. They're watching for one document, not a speech, not a television interview, not a social media post, an official written response from the White House. Because in negotiations, these delicate words matter, but written commitments matter even more. A formal response tells lawmakers whether this administration is prepared to support the latest compromise on ethics enforcement. That support arrives, negotiators have a much clearer path towards scheduling a floor vote. If it doesn't, the remaining disagreements become much harder to resolve before the Senate leaves Washington. And remember, time is the one resource lawmakers cannot create. Every hour that passes reduces the opportunity for amendments, debates, procedural votes, and final passage. This is why Senator Cynthia Lummis has repeatedly emphasized that the calendar itself has become part of the negotiation. The deadline isn't arbitrary. It is built into the legislative process. Once Congress leaves for recess, priorities begin shifting almost immediately. Budget negotiations move higher on the agenda. Election politics become increasingly dominant. Other national issues compete for attention. By the time lawmakers return, the political landscape may look completely different. That is why supporters argue this isn't just another legislative window. It may be the last realistic opportunity for comprehensive crypto legislation before the end of this decade. But here's where the broader financial picture comes into focus. The Clarity Act isn't only about cryptocurrency. It's about America's competitiveness. Around the world, governments have been moving at very different speeds when it comes to digital asset regulation. Some jurisdictions have spent years building legal frameworks designed to attract blockchain companies. Others have created licensing systems that give businesses greater certainty. Several financial centers now actively compete to become global hubs for tokenization, digital payments, and blockchain infrastructure. Meanwhile, many American companies have spent years navigating uncertainty. When businesses cannot clearly determine which regulator oversees a product, when legal interpretations continue chasing, when enforcement action appears before formal rules, investment decisions become significantly more difficult. Some firms delay expansion. Others move portions of their operations overseas. Some decide to build entirely outside the United States. That's why supporters argue the cost of regulatory uncertainty isn't theoretical. It's measurable. Capital flows elsewhere. Talent relocates. Entrepreneurs choose different jurisdictions. Every delayed investment represents an opportunity that may benefit another country instead. Short-term politics may dominate today's headlines, but here's where the broader financial picture comes into focus. The Clarity Act isn't only about cryptocurrency. It's about America's competitiveness. Around the world, governments have been moving at very different speeds when it comes to digital asset regulation. Some jurisdictions have spent years building legal frameworks designed to attract blockchain companies. Others have created licensing systems that give business greater certainty. Several financial centers now actively compete to become global hubs for tokenization, digital payments, and blockchain infrastructure. Meanwhile, many American companies have spent years navigating uncertainty. When businesses cannot clearly determine which regulator oversees a product, when legal interpretations continue changing, when enforcement actions appear before formal rules, investment decisions become significantly more difficult. Some firms delay expansion. Others move portions of their operations overseas. Some decide to build entirely outside the United States. That's why supporters argue the cost of regulatory uncertainty isn't theoretical. It's measurable. Capital flows elsewhere. Talent relocates. Entrepreneurs choose different jurisdictions. Every delayed investment represents an opportunity that may benefit another country instead. Short-term politics may dominate today's headlines. Long-term competitiveness could define tomorrow's economy. Now, this is what most people miss. When people hear the phrase crypto legislation, many immediately think about Bitcoin prices or speculative trading. Institutional investors see something entirely different. They see infrastructure. Think about modern finance actually operates. Banks process trillions of dollars every day. Payment companies move funds across borders. Asset managers oversee retirement accounts. Insurance companies manage enormous investment portfolios. Every one of these institutions depend on clear legal rules. Without those rules, risk committees become cautious. Compliance departments slow decision-making. Legal teams advise waiting rather than acting. This is why regulatory clarity has become such an important phrase within institutional finance. It's not because executives lack interest in digital assets. It's because they cannot deploy shareholder capital into uncertainty legal environments. The Clarity Act attempts to reduce that uncertainty. Whether it succeeds remains uncertain, but its objective is much larger than simply approving another crypto bill. It's about defining the operating environment for an entirely new financial architecture. Consider another way of thinking about this transformation. History often resembles the construction of a new transportation network. Imagine an expanding empire building roads across thousands of miles. At first, travel remains slow and fragmented. Different regions develop independently. Trade is inconsistent. Communication takes weeks or months. Then standardized roads begin connecting cities. Commerce accelerates. Military logistics improve. Information moves faster. Economic activity expands dramatically. Digital asset regulation serves a similar function. The technology already exists. The business already exists. The capital already exists. But without standardized legal pathways, connecting all participants, adoption progresses unevenly. The roads aren't the economy. They enable the economy. Likewise, regulation isn't innovation. It creates the conditions that allow innovation to scale safely. That's why institutional investors often focus less on today's price movements and more on tomorrow's regulatory infrastructure. Prices are reacting, the system's evolving. That distinction becomes particularly important when discussing companies like Ripple and digital assets such as XRP. For years, uncertainty surrounding regulation has influenced how many institutions approach blockchain-based payment systems. Even where technology demonstrated efficient improvements, legal ambiguity created hesitation. Financial institutions generally prefer predictable environments. When regulatory responsibilities remain unclear, many organizations delay implementation until greater certainty emerges. Supporters of the Clarity Act believe comprehensive legislation could reduce that hesitation. If clear rules define oversight responsibilities, if consumer protections become standardized, if institutional compliance frameworks become easier to interpret, banks may become more willing to expand participation across digital asset infrastructure. Notice the language carefully. May, could, potentially. Nothing about legislation guarantees adoption. Business still evaluates economics. Technology still competes on performance. Customers ultimately decide which solutions succeed. But removing regulatory uncertainty eliminates one major obstacle that has existed for years. That is why many investors describe legislation as an enabler rather than a catalyst. It opens doors. It doesn't force anyone to walk through them. But here's where the conversation becomes even more interesting. Many people continue framing this debate as though it's a contest between traditional finance and digital assets. Reality appears considerably more nuanced. Increasingly, the conversation involves integration rather than replacement. Banks continue investing in tokenization research. Asset managers explore digital securities. Payment companies test blockchain settlement systems. Central banks study digital currencies. Financial infrastructure providers expand blockchain capabilities. None of these developments suggest traditional finance is disappearing. Instead, they suggest existing institutions are gradually adapting to new technologies. The Clarity Act could accelerate that adaptation by providing clearer legal definitions and the regulatory responsibilities. That's one reason both supporters and critics understand the legislation importance. Everyone recognizes that whatever framework eventually emerges will influence investment decisions for years. The disagreement centers on what those rules should look like, not whether rules are needed. Another historical comparison helps explain today's debate. During the Industrial Revolution, countries that embraced standardized commercial laws, banking reforms, and modern infrastructure generally attracted more investment than those that resisted institutional modernization. Railways alone didn't create prosperity. Factories alone didn't create prosperity. It was the combination of innovation, supportive legal systems that allowed economies to scale. Digital assets may represent a similar institutional transition. Technology alone cannot transform finance. Markets require trusted legal frameworks. That does not mean every blockchain project succeeds. It doesn't mean every token becomes valuable. It means lasting financial systems usually emerge where innovation and regulation develop together. History repeatedly demonstrates that balance. As negotiations continue, attention increasingly focuses on those three remaining legislative gates. Ethics, Bank Secrecy Act-related provisions, agricultural language affecting regulatory jurisdiction. Each one represents a separate negotiation. Each one requires compromise, and every successful compromise depends on maintaining an exceptionally fragile bipartisan coalition. That's far easier to describe than accomplish. Political alliances shift quickly. Individual senators raise new concerns. Interest groups continuing lobbying. Industry participants push competing priorities. Meanwhile, the legislative clock continues ticking. Supporters understand that passing the bill requires simultaneous agreement across every major issue. One unresolved dispute could delay the entire process. That's why negotiations have become so intensive during the final days before recess. Every remaining conversation matters. The coming days, therefore, represent much more than another chapter in Washington's politics. They represent a decision about how America intends to participate in the next evolution of financial technology. If comprehensive legislation moves forward, the United States could begin providing the regulatory certainty many institutions have requested for years. Negotiations collapse, uncertainty may continue shaping investment decisions well into the next decade. Neither outcome determines whether cryptocurrencies ultimately succeed. Neither outcome guarantees institutional adoption. Markets remain influenced by macroeconomic conditions, monetary policy, innovation, competition, and investor confidence. While regulatory clarity changes the playing field, it changes how businesses evaluate risk. It changes how banks allocate resources. It changes how entrepreneurs decide where to build. Short-term noise, long-term structure. That distinction may become one of the defining themes of digital finance over the coming decade. As investors, it's important to separate headlines from structural change. Daily political developments generate excitement. Breaking news creates volatility. Market reacts quickly to every rumor, every statement, every procedural vote. But beneath those headlines, something much larger continues unfolding. Governments around the world are gradually determining how digital assets fit into the existing financial system. Institutions continue preparing for greater digitization. Technology continues advancing regardless of political calendars. The pace may vary, the path may change, but the broader direction remains one of the increasingly institutional engagement with digital finance. That doesn't eliminate risk. It doesn't remove uncertainty, and it doesn't guarantee investment success. But it does explain why legislation like the Clarity Act attracts so much attention from policymakers, banks, asset managers, technology companies, and investors alike. Because this debate extends far beyond one bill. It's about the rules governing the next generation of financial infrastructure. And this is why this week matters, not simply because politics, but because decisions made today could influence where innovation, investment, and financial leadership develop over the years ahead. If negotiations succeed, the United States may take a significant step towards establishing a clear regulatory foundation for digital assets. If they fail, the conversation almost certainly won't disappear. It simply will be postponed. And according to Senator Cynthia Lummis, that postponement could last far longer than many people expect. So as this story continues to unfold, keep watching the signals that truly matter. Watch the White House written response. Watch whether the three remaining legislative gates close together. Watch where bipartisan support holds through the final negotiations. Because those developments, not the daily speculation, will likely determine the next chapter in America's digital asset policy. And regardless of where you stand on crypto, one thing has become increasingly clear. Prices react and the system's evolving. The real question is whether the United States choose to lead the evolution or spend the next several years trying to catch up. You've enjoyed this deep dive and want more analysis on macroeconomics, digital assets, institutional investing, and structural challenges and changes reshaping global finance, make sure to subscribe, turn on notifications, let me know your thoughts in the comments below. Thank you for watching. I'll see you in the next video. Hope everyone's having a blessed day. A lot of things happening. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. The one thing I want to drill down here right now, ladies and gentlemen, is we're still stuck in the managed chaos. What's happening here is you see everything in ranges. If you look at gold, between 39.50 above 41.50, we're inside a nasty, nasty rage. If you look at everything, until there's a clear break of the chaos that we're dealing with, it will move between ranges. I like watching gold. I like watching DXY. And that, for me, tells a story besides watching the yen, crude oil, and RBOB. When those financial instruments hit certain levels, it's like an orchestra. And to me, the leader of this orchestra is tweets. I know that sounds insane. Tweets. But that's what we're dealing with right now, ladies and gentlemen. For everybody who took the tips from Pittsburgh Palantir, move your stops because it's way, way higher now, which is fantastic. Ladies and gentlemen, if you're looking to learn how to trade, if you want to learn how to invest in different things, come and join the Crypto Public Desk Monthly. Join over 650 actors and traders, investors who want the deeper macro research, and they want to be able to take advantage of all the financial markets and the chaos that is causing volatility. You know, Warren Buffett said something amazing. He doesn't try to judge if something's going to beat its earnings this quarter, next quarter, quarter after that. He's looking out 5, 10 years. He's looking out 5 years. If his thesis is right, you make money. That's a lot like today's world, ladies and gentlemen. Because one day we're all going to wake up and these cryptos are going to go to the roof. We're going to have a rip your face off rally. It's having the Gucci conviction, that Gucci clarity to sit there and wait for it. We're early with certain things, but the world is changing. We believe this chaos will be managed up until the midterm elections. That's what we believe. And you can't have peace with people shooting projectiles, but that's what you got. So what do? We stay Gucci. We stay frosty. We keep our convictions. We understand what we hold and why we hold. We understand the biggest plays to take advantage of the chaos and what causes the plays to fall like dominoes. Our thesis is just as strong as ever, if not stronger. It is truly the Harry Houdini freak show. It really, really is. But the great thing about this is the volatility allows us to trade tactically, to build our stacks of high society, to acquire more crypto at sick prices. At some point, this will get sorted out. It always does. The trick is not to get cut up like sushi while this is going on, because we're at all-time highs again. Go figure, right? Nothing in this video is financial advice. This is for education and same purposes only. Always consult a licensed financial advisor before making any investment decisions. Never invest a single dollar based on watching a YouTube video. Don't ever do that. Don't get cut up like sushi. Don't FOMO this. Don't FUD this. Don't lose your Gucci conviction. Don't do it. The world's changing. It is. And I, for one, don't want to miss it. I love you all, ladies and gentlemen. I'll see you on the front lines.